Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Allie Canal. Let's get to the three things you need to know today. First up, U.S. stock futures pushing higher following a weaker than expected August jobs report. Traders are now ramping up bets on a Fed rate cut this month. Bond yields sinking after the payrolls report came in at 22,000, with the estimate calling for 75,000 jobs to be added last month. Plus, President Trump says substantial chip tariffs are coming soon. The president made the remarks as he hosted tech leaders at the White House Thursday night. Trump said companies that don't shift production to the U.S. will face tariffs on semiconductor imports. Notably, Apple will be spared from the levies after expanding its domestic production. And Tesla proposing a new pay package for Elon Musk, potentially worth $1 trillion. The massive compensation package is unprecedented in corporate America. The long-awaited proposal sets a series of ambitious benchmarks Musk must meet to earn the full payout. Included in the offering is the expansion of Tesla's robotaxi business and growing the company's market value to at least $8.5 trillion from around $1 trillion today. The plan spans 10 years. Let's get a check on stock futures, and you're seeing green across the screen here as that payrolls report came in line when it comes to the unemployment rate. However, we did see those job gains come in at just 22,000, greatly missing estimates. Markets continue to price in that September rate cut in just a few short weeks. But let's get into that top story of the day, and it is the August jobs report coming in much weaker than expected, boosting expectations for a rate cut later this month. And Broadcom soaring after issuing upbeat guidance, despite President Trump warning that chip tariffs are coming soon. Plus, the U.S. and Japan officially inking a trade deal. Joining me now is Fed correspondent Jennifer Schomburger, senior markets reporter Inez Ferre, and host of Morning Brief Market Sunrise, Ramzan Karmali. And Jennifer, let's start with you here. What does this mean for the Fed, not just later this month, but really when you look out to the end of 2025?
Well, Allie, I think for the next policy meeting on September 17th, this seals in a rate cut. This was a weaker jobs report across the board, whether you looked at the non-farm payroll number, the unemployment rate, the labor force participation rate, or average hourly earnings. We are seeing softening there. And this is not just for the month of August. This has been going on for the past 3 months. We saw revisions down for the month of June. Job growth went into negative territory in the month of June. So this is a trend that we are seeing now. The question is, how much of a deterioration is this? What is driving this? Is this because firms have put hiring on hold because of uncertainty about policies from the Trump administration? Or is there something more sinister happening? And Fed Governor Chris Waller, who probably feels pretty vindicated right now today, has said that he feels that lower supply for workers is masking lower demand for workers. So he is worried about an inherent deterioration in the job market. I think that, as I said, this seals in a rate cut for the Fed. They're now going to be very much looking at the labor side of their dual mandate, because if we continue to see weakening in the job market, then guess what? Inflation is also going to come down because people who don't have jobs don't have money to spend, and companies are not going to be able to raise prices. So it's going to be interesting to see what this means for the path for cuts this year. Is it just going and are we going to see 25 basis points in September, or are we going to see 50 basis points? Are we going to see a repeat of what we saw last year? These are all questions that are on the table right now.
Mm-hmm. And as like Jennifer was just saying, I mean, markets essentially pricing in with full certainty that rate cut in just a couple weeks here. You are seeing this reaction in the bond market as well. The 10-year yield is down 8 basis points at this point in the session. What else are you seeing in the market reaction here?
Right, Allie, and perhaps the market feels like this is not so bad of a report that you would see a sell-off in bonds. You are seeing, as you mentioned, bond yields coming down. We are seeing the dollar going lower, the dollar breaking below 98, the 98 level. So that supports equities, a rise in equities. We are seeing the S&P 500. That's going to open at a record. It closed at a record yesterday. You're also looking at the NASDAQ NASDAQ that looks to be opening near or at a record as well. And you're seeing the major averages that the Dow in pre-market has also flipped into, or at least is at the flat line right now. We've been watching gold as well. Gold has surged towards record territory as well. This week, gold surged to new records, and yesterday it eased a bit, but today it looks like it's up right now. And then we've been watching crypto. Crypto also going higher. Crypto, we have Bitcoin that's up above 113,000. Again, the dollar going down helps these assets go higher.
And you were just talking about the NASDAQ, how it's set to open at a record. We are currently up around 0.8% in pre-market trading. A big help with that is Broadcom. Shares are up, I believe, 15% at this point, shortly before the opening bell. This comes after earnings, also reports of a new chip customer that they have. So what can you tell us there, Inez?
Yeah, this is what Wall Street's very excited about, because Broadcom makes custom chips it has been working on custom chips, AI chips for 3 big customers. And now it says it secured a 4th one for $10 billion in custom chips for that 4th customer. So Wall Street very bullish on the stock, saying one analyst saying that the AI momentum remains robust. He's noted 11 consecutive quarters of growth for Broadcom. So very bullish on Broadcom's growth. And for the fiscal 3rd quarter, I just want to point out their total revenue came in at $16 billion. That was a record, a 22% year-over-year growth. Its consolidated backlog is now also at a record $110 billion. So year to date, you are watching that this stock is up more than 30% near record highs.
And speaking of chips, Jen, you are on the White House lawn. We just saw President Trump host this dinner with dozens of tech CEOs. And during that dinner, he did reiterate warnings that he will impose a, quote, fairly substantial tariff on semiconductor imports. What do we know, if anything, when it comes to the reality that we'll see that play out?
Yeah, Allie, we've seen the president threaten before a very substantial tariff on semiconductors. And in fact, just a month ago here at the White House, when he made an announcement with Apple CEO Tim Cook for another $100 billion investment in the U.S., bringing Apple's full investment now up to $600 billion. He said he would slap 100% tariff on semiconductors imported into the U.S. unless those companies were scaling up plans to produce in a large way here domestically. And I think this is the president really doubling down on that. And interesting to see him do it in a forum with CEOs from the largest tech companies at a dinner last night here at the White House. Though he was asked by reporters that question, he didn't just volunteer it during the dinner. But clearly, this administration has plans in place, though a lot of the largest tech companies already have major plans to invest here in the U.S., so they're probably going to dodge that bullet. And we have seen the president in the past start high and then come back down. So this is certainly a tool to pivot players as the president wants.
And Ramzan, I want to bring you into this because we were just showing some of the reaction in those chip stocks. Broadcom clearly brushing this off. Nvidia, though, is down around 1%. So what are we seeing across the board here after this tariff threat?
Yeah, so it's quite interesting that actually Donald Trump's threats about tariffs to chip companies, it feels like they've kind of been heeded by some of the big foreign players. The likes of Taiwanese chip giant TSMC, South Korea's Samsung and SK Hynix, they've all announced massive investments in chip manufacturing in the United States. So in a way, he's clearly telegraphed that he's leaning this way. Look at the reaction from Apple. Apple's making a massive investment with manufacturing in the US as well. So I think the big chip makers out there are already aware of where Donald Trump's thoughts are. And don't forget, he has used tariffs not just for foreign policy, but for economic policy. And he's not just targeting countries, he's targeting companies. He wants them to be making goods in the United States. So I think these chip makers are well aware of what Donald Trump is planning.
And Asian stocks are climbing today, too, after Trump signed an executive order implementing a U.S. trade agreement with Japan. What are some of those high-level takeaways, especially because a lot of the automakers were watching this deal very closely?
Yes, indeed. Now, the Asian stocks, they weren't only climbing on this Japan deal, they also were climbing on the fact that they're more confident of a Fed rate cut this month as well. That's obviously been cemented after that jobs number. But this trade deal will mean 15% baseline tariffs on most Chinese goods, including cars, which is crucial. Now, the deal, remember, it was reached in July. So we've had months of negotiations between Washington and Tokyo. They've been haggling over the details for quite some time now. And we know that Tokyo has agreed to invest $550 billion in projects selected by the US government. And so it's going to ramp up its purchases of agriculture. It's going to ramp up purchases of commercial aircraft. For instance, Japan's agreed to buy 100 Boeing planes. That's just one example. But it's also worth noting that car makers in Japan and in the US, they've already been hit by tariffs. They've already suffered. They've already said so as well. Toyota said it expects to take a $10 billion hit because of tariffs. But even the likes of Ford and GM, they've projected hits to their bottom lines too in the billions. So yes, on the face of it, this looks like a great deal for the car makers, but they've already taken a bit of a hit already.
We'll continue to watch the fallout from these trade deals. Rams and Jennifer, Inez, thank you all for joining us today. Well, Tesla is putting a jaw-dropping new pay package on the table for CEO Elon Musk, potentially worth up to $1 trillion over the next decade. The deal laid out in Tesla's latest proxy filing is entirely performance-based. Musk won't see a dime in salary or bonuses. Instead, he'll only earn stock awards if he hits a series of ambitious targets. That includes things like deploying 1 million robotaxis, delivering 20 million vehicles, rolling out AI robots, and growing Tesla's market cap to at least $8.5 trillion. If Musk achieves every milestone, his stake in Tesla could rise to around 25%, cementing his control over the company. The proposal will go to a shareholder vote at Tesla's annual meeting on November 6th. It does come after a Delaware court struck down Musk's latest record-setting pay package from 2018, valued at roughly $50 billion, a ruling that Tesla is still appealing. The incentives in the new plan aim to keep Musk's focus on Tesla while it pursues growth in newer markets, including robotics and artificial intelligence. Friday's filing also included a non-binding shareholder proposal for Tesla to take a stake in Musk's XAI startup, an idea that Musk himself has previously discussed. Well, coming up, we count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We're watching Lululemon, Figma, and Samsara. First up, Lululemon. Shares of Lululemon are sinking after the athletic apparel maker slashed its full-year guidance, warning the end of the de minimis exemption will weigh on its business. The company now expects lower revenue and earnings for the year. Comparable sales in the second quarter rose just 1%, falling short of Wall Street's nearly 3% target. Today's slide adds to a tough year for the stock, which has already shed about $22 billion in market value. Next, Figma. Shares tumbled to their lowest level since the company's IPO after issuing a disappointing annual revenue outlook. In its first report as a public company, Figma noted that more than 80% of customers used at least 2 of its products last quarter, but RBC analysts warned that investors are cautious, concerned that AI could make app development simpler and reduce demand for Figma's tools. Finally, Samsara. Shares jumping after the hardware software platform company raised its full-year adjusted earnings outlook. RBC analysts point to strong deal activity and big customer wins driving the momentum. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Markets set to open higher after the August non-farm payrolls report came in at well below consensus, with just 22,000 jobs added in the month. Following the lower than expected print, investors expecting the Fed to cut rates by a quarter point later this month, with chances of a half-point cut rising. Omar Aguilar, Schwab Asset Management CEO and CIO, joins me now. So, Omar, when you take a look at this print, the market reaction, has the Fed been behind the 8 ball? Should they have been cutting in the summer?
Good morning. The The unemployment numbers, while they were obviously below consensus, just confirmed the trend that we started to see in the July number. I think July, was one data point that surprised a lot of people, including the Fed. And I think based on the decision process that the Federal Reserve does, has gone over the years, this is just basically the confirmation they needed in their data. The Fed has two mandates. They look at inflation and they look at unemployment. For the longest time, for more than a decade, they didn't have to worry about inflation. This time around, that's what they're balancing it at. Even with today's data, they still have the PCE number. That is their metric they use for inflation is still pretty elevated. So I think the 25 basis points is already priced in. This gives the Fed the data they need to make that determination, but still they're going to continue to watch, what the inflation dynamics might be going forward.
How do you think the market would react if we did see a 50 basis point cut in September? Because, it really depends on why you're cutting. How do you think the market reaction would be?
Yeah, that would be fairly negative, I think, in general, mostly because the market doesn't like when there are bold moves like that. Because the signal is that they probably see the economy deteriorating faster than what they actually need. And again, these trade-off between inflation and unemployment, if they were to go with 50 basis points, that would actually suggest that they probably don't necessarily think that the inflation is an issue or that they see that the economy is deteriorating, significantly. It will be a little difficult for us, given the sticky numbers we have seen on inflation, to actually think that inflation will be so depressed between now and the Fed meeting, which is shortly, so that they can actually justify a 50 basis points. So they will be looking at their dot plots, they will looking at their projections for economic deterioration, so badly that they will need to do 50 basis points. So our probability for that is actually fairly low.
And I'm seeing that the unemployment rate for 16 to 24-year-olds is now at 10.5%. How closely does the Fed look at breakouts like that? And what does that signal about the future of economic strength?
The dynamics on the labor market have been very interesting this year for two reasons. One is there is a big balance between supply and demand. And I think the Fed, and all of us are looking at what this no hire, no fire, stability that we have seen. Even with today's data going from 4.2% unemployment to 4.3% unemployment, that seems to be reasonable given the dynamics we have. So there is still a lack of supply of potential workers that has actually been accumulated, mostly because immigration policies, as well as just overall the demographics that you just described. On the other hand, you see that the companies that are in the process of potentially hiring have actually been holding back their decisions to spend more money on potential new additions to staff or new workers for AI, increased productivity, but also just waiting to see how the uncertainty about trade policies may work. So we may see some of that dynamics change as we are starting to see less risk on the trade policy side, and that may actually increase the potential demand for workers that then, will provide some relief to that, unemployment numbers.
Now, you said it's important to watch the CPI report, and we'll get a fresh reading on that next week. We have been hearing, though, from businesses that prices are rising and they're being forced to pass that on to the consumer. What are the dangers if the Fed starts cutting into an environment where inflation remains sticky?
Well, that's precisely why we believe that 25 basis points is probably the right metric, and then the probability of the Fed pausing, until probably December is a realistic scenario. Because yes, we have seen, pressures on, particularly in some of the goods and in some of the services. Services have been the big driver of inflation so far this year. Goods have been fairly stable, but we see that at some point, given the pressures we have seen, given the dollar weakness, that continues to put more pressure on inflation. And I think where we expect to see in CPI is that continuation of future pressures up in terms of CPI that again will put pressures there. Now, the consequence of that is that consumers, particularly in the lower income part of the consumer, are actually still looking at suffering from those inflation pressures.
And Omar, given that we're entering a presumed Fed cutting cycle, how do you play that in equities, the bond market. What's your advice to investors?
Yes, great question. This is the beginning. I think September is already playing as being sort of the pivotal point where we can confirm that we are in that deceleration cycle. We are in that soft patch of the economy where normally what we expect, to happen is for quality level companies, for companies that have strong balance sheets, the companies that have low leverage, the companies that have high profitability, high profit margins, tend to do much better in this period of time. So we expect for that to continue. And as we see fiscal stimulus as well as monetary policy cuts, that could actually just still bring support for equities. So what we expect is that for the next few months, there will be volatility, there will be adjustments, but we expect for that to start going into the last parts of the cycle. That usually means investors should start repositioning their portfolio in areas that have been out of favor. What that means is probably a good opportunity to start getting into small caps in equities and start getting into some of the value opportunities they have, a little bit diversifying away from growth. And then on the bond market is continue to go towards the middle part of the yield curve, because we do expect the yield curve to continue to be steeper, and therefore staying in the belly of the curve seems to be like a good opportunity for investors. You don't need to go to high yield. You don't need to take a lot of credit exposure. It's really good to stay in some of that high quality that will endure any potential economic slowdown.
Omar, thanks so much. Appreciate your advice. Coming up on Yahoo Finance, opening bid, our own executive editor, Brian Sazi, joins us now. Brian, Jobs Friday. How many cups of coffee have you had so far?
About 13 cups of coffee, Allie. I mean, we're going to keep going strong. And now we know why gold price has been ripping to a record this week, because where'd all the jobs go? I mean, absolutely awful report. So we'll continue to dive into that. Also, big call on AI stocks out of Goldman. We have a key member of the Goldman team here to talk about that call and, 40 other tech stocks.
All right, I'm looking forward to it. But that does it for Morning Brief. Much more ahead on Yahoo Finance.